got investor clients that have been reaching out, and they're, I don't want to say pissed off, but they're frustrated because there seems to be a pool of properties in the market that just don't make sense for investors. Maybe they're, nice area, single family homes, whatever it is, and they're just cash flow negative enough so that it's hard to justify.
Yeah.
But apparently there are still deer in the forest. There are properties that cash flow, but they're just super hard to find. So like I've had clients calling me being like, where do I find these properties? I hear about people buying them, but like what's going on? Like I heard rates are high and it doesn't make sense, but apparently rents are going up. You'll know better than me.
Good. And I just say, I hope you had a good long weekend too, Keaton. We were talking about that a bit. It's been busy to clear the head, get understanding about what's going on in the market right now. And I think that's what I like about the long weekends, even though I was busier than stink, is the whole idea of just like, okay, what are we doing? How are we doing it? And this has kind of brought this topic to life. Investors.
I think there was a mistake in my order, though. I ordered the Edmonton special, not the Vancouver special. And it was windy and rained all weekend. So
Right. So, at the end of the day, I think it's a couple things that seem to be really hitting hotspots right now is still people saying the interest rates, no, don't like them. They're too high, can't cash flow. And then also I'm looking at, like you said, investors buying properties. I just did another deal here this past week, seller financing, a situation where the sellers are willing to work with them. The investor didn't have to go to the bank. And it's really interesting how when you really dive into the purpose of buying real estate, there's so many strategies, and I think it just really comes down to the strategies you have to focus on are the ones that you enjoy looking for. Because you and I just both talked about it. You could run like a squirrel in a hamster cage. You could be going every which way in direction. It doesn't mean you're going to be successful. So in short, like I guess just a couple of things that I noticed is investors wanting to buy property right now are talking about interest rates, but I've seen a direct correlation with the rents going up. I just saw somebody posting, and I see the successful renter that they got in there, $2,500 for a townhouse to rent. Yeah. So, I'm looking at, okay, yeah, it looks nice, but it's a townhouse.
Did it have a helicopter pad on the roof or something?
No, like we're talking a renovated 1970s, 1980s townhouse in Edmonton. And they're charging $2,500 plus utilities, mind you. And they have their own furnace, their own hot water tank because it's a townhouse. And I'm just thinking to myself, wow, like rent really is always evolving as well. And when you've got a lot of upward pressure on interest rates, I'm seeing how that puts upward pressure on rent. Obviously, that direct correlation is easy to spot.
I think there's a secondary factor for that, though, because there is naturally the landlords want more money.
Right.
I think the aspect that people have to look at, and you can verify this, is the shift of population in Canada as costs rise. We're seeing a lot of people leaving Ontario and BC. Like a lot, record-setting numbers.
We are, and I just saw the stats on that too. We had a net negative migration in Ontario and BC, net positive migration in Edmonton specifically. We're up 15,000 migration here in Edmonton in the last 12 months. So we're looking at a situation here where if the supply is low, right now there's not very much inventory, right? There's no upward pressure on prices, but there's upward pressure on demand. And I think in certain areas, obviously, that's different than others. It's very local, very hyper market. But in a situation in general, Edmonton overview, we're looking at rents are more expensive. Interest rates are a little bit higher than they were, a couple points higher than they were last year. But the inventory is low. So people are like, well, if I can't find the house that I want, then maybe we should rent. Maybe we should sell our house, take our equity that we've got, and just kind of play the field and see what's happening. At the same time, though, I'm looking at what I pay for my mortgage, Keaton, and my interest and my mortgage and my taxes. I'm actually paying less for my house than it would cost me to rent right now. And I think that's that underlying topic of why would you want to buy a home when rent is free, in a sense, like you don't have to worry about maintenance. You don't have to worry about taxes. It's like, well,
definitely like dating versus marriage.
That's right. Yeah, I got freedom to choose. I might not have a date on Friday, but I got freedom to choose. So that whole situation of when I'm working with my investors right now, we are definitely focusing on a couple of different things, right? Is there creative financing deals we can do that allow us the ability to take advantage of the fact that someone does want to make a move, but they don't want to list their house, and or maybe they're listed, but they can't get the offer they want. Secondly, sellers right now are saying, well, this isn't cash flowing for me anymore. I got to sell this property. And I'm getting those listings in the last couple of weeks too, where people are saying, this is not cash flowing for me anymore because I'd have to put more down, even though I've had the property for 5-10 years. I might as well sell it right now and cash out, because if I'm going to pay more every month to maintain this place and I'm in between renters, I might as well sell it. And so that's an interesting I guess you could say hold on the market, when I'm getting those calls on a regular basis, people saying, should I buy, should I sell, should I keep it, rent is not very good right now. That's the stuff that's not hitting the market. And so that's another factor too, is like when you're looking at buying investments, obviously a property that's gone to market could be appealing, but it's not as appealing as a property that no one knows about. And I think that's a bit of a corner of the market that investors do like to take advantage of when they realize you can do that.
Mm-hmm. So how have you seen investors adapting to not everything's making sense? Like, are you seeing a push to investors looking for more off-market deals, a trend towards AFS, agreement for sale, for anyone who doesn't know, rent owns? Like, what are you seeing actually happen kind of on the ground level?
Yeah, actually, working with investors specifically, I've done deals with in the past, Keaton, and I can say that there is a huge push on agreement for sale and or vendor financing. Vendor financing is obviously a bit more straightforward. Agreement for sale is, less cash, and you get to take over, management of a property. I think both strategies are fantastic, but I definitely see a high push for looking for those properties, and especially when it's like, hey, I'm just looking at listing a house right now this week in a neighborhood that has had one sale since January 1st. And currently there are 5 homes for sale in that neighborhood, but they're all luxury homes. So there's like no everyday, buyer and seller inventory. If you got 5 homes to choose from, 800 to 3 million, how is that going to be helpful to the common person, right? So when you look at those areas in the city where there's not a lot, that's the best approach. Hey, how can we get a property that's not listed? Because clearly people want to sell, they're just not putting it on the market for us to know that easily. So it's definitely a nice target to hit if you've got the tools to do that. But I can tell you, it's even as a licensed person or not licensed person, this whole idea of finding somebody who wants to sell their home, it's not as simple as knocking on doors, but some people still do that. It's interesting to see, though, that those are good opportunities when you're in a low inventory market. So, the nice thing I like about this, Keaton, it doesn't affect you and I as much if we know how to help these people, right? And I think that's what people forget too, is like, well, if I could find a home, off market that's not listed, that'd be great. But then they still feel like, oh, but I'm all by myself. I've never done this before. And how do I do that? It's like, no, I can still help them find a property and still make a fee for doing that and helping them with the process. You can still do the mortgage for them. Just because it's not on the market on MLS, people think that all of a sudden you can't use professionals. So I think that's also an interesting dynamic, is you and I having the skill set to be able to help people in those scenarios is a bigger leg up than most people too.
Wait, so you're telling me the 30 plus hours of training I've taken under Barry McGuire is actually going to pay off?
As long as people realize they need a mortgage. That's right. I think but I'd like to hear from you though, Keaton, in terms of the interest rates and knowing people are paying rent right now. Do you see that people are recognizing that this is still a good option other than paying rent? Are you finding some pushback on that as well? People saying, well, maybe I should rent, and you're seeing them kind of play with that idea.
I think it really depends on kind of the situation and the longevity. I'm just going to share 2 seconds. I'm just going to share a screen.
Yeah.
Just to show everybody what's going on with rates. So this is what's happening with fixed rates, which is, so these are bond yields. Now, bond yields will have basically a direct relationship. Think of them like the foundation to fixed rates.
Yeah.
So there's the bond yields, and then the bank's margin gets put on top, and then there's the rate you pay.
Right.
So this is over the last 6 months. We can see we've had it rise, fall, stabilize, rise again. If I change this to a year, you'll see this pattern is repeated multiple times. We've kind of had these ups, downs, ups, downs. But currently, we're basically right at the peak of where rates have been for the last 10 to 15 years.
Right.
So I think it's important to know that we're at a point where one of 3 things is going to happen. One is that rates fall, unlikely to happen in the short term. 2, which I think is reasonably possible, is we're just going to plateau. And then the third option, which nobody wants to think about, is rates could keep going up.
Mm-hmm.
Now, you have to gauge if rates keep going up, it's likely at some point real estate values are going to fall across Canada. They have in some markets. I think an interesting effect for Alberta is going to be as prices rise in Ontario and BC, we're going to have the cost rise, which is going to cause people to kind of filter down into lower cost markets like Alberta, where they can find work and still live. So I don't know what that will mean for the Alberta market, but I suspect it's going to lead to a really stubborn market that is going to maybe slow down during higher interest rate periods, but kind of hold because there's going to be this rising demand as to balance out the diminishing value of buying at a higher interest rate. Long story short, I really think that buying makes sense if you can buy in a good area that's going to have like a very long horizon that's going to do well for you. I certainly wouldn't be buying in like really rough, low desirability neighborhoods right now. But if you can get that really good asset in a slightly less competitive market, I would argue that it's better to do it now when, yes, there are negatives like higher interest rates versus competing with 20 other people to probably not get that asset when rates are lower. So it's, you know, do you buy high, sell low, or do you buy low, sell high? You have to choose, and there's very different headspaces for how you're going to operate.
And, you know, for first-time buyers, I think this is also more of an impact. First-time investors, this is more impact because they don't have that experience on how to play the game. So that's where you and I come in, and we have to kind of walk them through the process and kind of help them. I think a couple of interesting things that have come out is I'm seeing with the higher interest rates, albeit they're still lower than my first mortgage. I can tell you, I think my first mortgage was 7.4, and I was like, yeah, you know, and now we're at, you know, mid fives would be like a good rate. And of course, I was lucky enough to get my new rate before they went back up. But at the same time, I've always been on the tail end of that. I've been all the opposite. It's like I always seem to have to renew my mortgage after the rates went up. So I'm okay to take a little bit of a breather right now. But
that's
what I'm getting
with fixed rates when you go from fixed to fixed to fixed is that
Yeah.
it's like jumping and you have no control where you land.
Yeah, unless you refinance and pay the penalty and kind of get out of that. So that's not ideal either. But I think a couple things that I found really interesting with the pressure of interest rates, Keaton, and you probably have seen this and we've talked about it a bit with different clients, but finding alternative solutions to capitalizing on the interest rates is like, well, how do you want to live? Like if you're going to pay $2,000 a month and you can have a mortgage for $1,800 a month, you know, it may only seem like a little bit now. But think about this, and this is like future forecasting, and this is where first-time buyers have to really process this. Eventually, your mortgage will be either paid off, or at least you've contained the expense. And what I mean by contained, and you and I both understand this better, but for the general population here is your rent will always keep going to market conditions. Sometimes rent comes down. Mostly rent is always going up. You look at, you know, paying $2,000 a month now, that would be like ridiculous 5 years ago. Are you kidding me? $2,000? Not a chance. Now it's like, oh, it's only $2,000. We better snap that up. And I think the one thing that I've really processed in my almost 20 years of being in the real estate industry is regardless of the prices of real estate, my rent has only gone up a small proportion to my interest rates. I haven't had somebody go, you enjoy living in this house. Sorry, your rent's going up $500. Or even $100 every year. So over the last 5 years, it's gone up $500 comparison. And in fact, I owe less on my mortgage now. I have a mortgage payment that is still within the same budget I had before. And it's an interesting situation that's that I've at least contained my cost. When you have a cost that you can actually say, I'm going to budget for the next 10 years, this is what my budget is, there's a lot of peace of mind in that. I think people forget sometimes that rent does not give you that. And forget all the other side issues that come from renting. That's a big one for me. I don't know. How do you feel about that in terms of like the focal point of containing your budget?
Well, I think there's certainly some merits there. It really depends on when you buy. Like in your case, you've owned for quite a while and you have the benefit of when you originally purchased, rates were a little bit higher. I think a good parallel is like a job. The real estate market had the equivalent of your friend's dad's company hired you. You got to go into work, play pool, sit on the computer, you know, take off work at 3, drink a beer, and you got paid a really good salary. We had unrealistically low interest rates.
Yeah.
And there was a 100%. Lot of benefits that came with it. But the problem is that we got lazy. We got spoiled. Now we're back to if you look at the average interest rate from 1990 to now, it's almost 6%.
Right.
And keep in mind, in the 1990, interest rates were like 12, 13%.
Right.
So, and that's an average.
When we were in high school.
We're just coming back to the normal. So I think at the end of the day, we have to accept what kind of the long-term behavior is. And yes, there was a great period for real estate investing and home ownership where you could pay practically no interest and you made money by just buying anything and living in it.
Yeah.
It shifted. You're going to still make money off real estate likely, but you got to buy the right things in the right area for the right reasons.
Yeah.
And it's possible. Before you could buy 7 out of 10 properties and make money. Now maybe it's 3 out of 10. We have to shift. But one thing I think that's really important for investors particularly to be aware of is that rising interest rates affect homeowners disproportionately compared to investors. And the reason for that, I'll use an extreme example. Let's say someone owns a $2 million home in Vancouver, or I should say a home with a $2 million mortgage. At 10% interest, that would be $200,000 a year in interest payments. For the homeowner, they're going to need to make over $300,000 a year to pay that interest because they have to pay tax on that money. For the investor, they need to make $200,000 to pay $200,000 of interest because it's tax deductible.
Right.
So there is some interesting parallels, and it'll be very interesting to see how this plays out. Rising rates will impact cash flow across the board, yes. But it has a much lighter burden on real estate investors than on homeowners. Now, we have a very strange market in Canada where we don't have a lot of purpose-built rentals. The primary mechanism of rental properties in Canada, or the majority, is repurposing homes for renting. So we do have a disproportionate balance. But there may be opportunities where we'll see situations make sense for a real estate investor, but not make sense for a homeowner.
Right.
And it'll be very interesting to see how this plays out and which potentially AAA or B+ markets we see the investors coming in, but not the homeowners.
Right. And that's a really interesting dynamic too, Keaton, to think about the fact that, especially when you tie this into like the Smith maneuver scenario, where you've got a smart, savvy person who wants to invest, they've figured out how to make these tax deductions to their benefit, and you're 100% right. There's so much less impact in a business sense for someone who has the smarts to say, how can I buy an investment where my increased cost means I just pay less taxes on the amount I have to service this bill? And or a personal residence, okay, how can I invest my equity using the Smith maneuver so I can benefit from some of these expenses now? So I'm not using a situation where I'm just blowing money on interest that I shouldn't have to do personally.
One of the funny things, I just grabbed the original Smith maneuver book for fun. I'm on page 2.
Yeah.
Mortgage at 7%. That's literally the first paragraph of the second page. This is not the first time we've been at rates at this level. It almost certainly won't be the last time. We had our vacation where mortgages were basically free. We're back to reality. Now, I'm not as optimistic that rates are going to drop to 2.5%, 3% in the next couple of years. I think that this plus or minus a percent is going to be kind of the normal. And I think the best thing that investors and homeowners can do is we have to adapt. Certain people are going to find themselves over leveraged, and they're going to have to figure out, can they salvage the situation, or do they need to kind of have a tactical retreat? Do they need to sell that bigger property, pull some of their equity while the market, particularly in Edmonton, is still healthy and fresh? Do they then buy a slightly lower cost property? We're going through a period of change. We don't know where we're going to end up. People need to accept that they may need to change their situation as well. For some, that'll just be toning back expenses that are discretionary. For others, it might be extra work. I know for myself, as someone who had a variable mortgage and owns a home, it's work extra. We are going to have to adapt. Things have changed. I know that people want the message of, or at least many seem to want, rates will drop. Don't worry, just hang on. Bullshit. You have to start making changes, serious changes. Otherwise, what's going to happen is maybe you'll get lucky and things will get better. Great. But if you don't get lucky, you're going to find yourself all of a sudden where you're looking up and you'll realize you've dug yourself a prison and the walls are way beyond reach. So it's been one of the biggest things that I've been doing with clients is really having those real conversations. And I know you do the same thing where it's like, let's take the extra time to figure out exactly where you're at. And then we need to figure out what are your options. Like, we just got to be real here. This is
Yeah.
not a time for la 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 la.
Yeah.
Playing Bob
Make it
Marley,
work.
Three Little Birds in the background.
Yeah.
But the flip side is I think that there's an immense amount of opportunity there with agreement for sale deals, rent to owns,
Mm-hmm.
making lateral or downsizing moves. But
Mm-hmm.
people have to move. And I don't mean move homes, but they have to move in the sense they have to adapt.
Yeah.
We see it regularly, whether it's real estate investors or homeowners.
Mm-hmm.
Those who just ignore the weather changing around them, the situation changing, it's
Mm-hmm.
by the time they reach out, it's just too late. When someone's like, hey, I'm here, I've got all this new debt, my bank's upset with me, I'm 3 months behind, like there's very little you can do.
Yeah.
The flip sides for active investors is if you reach out to those people and you have these conversations early,
Mm-hmm.
there's an opportunity to help. And there's an opportunity to maybe get that off market. You're going to pay fair market value for it. You're going to be fair and honest.
Mm-hmm.
But it's a house with 2 suites in the right area that's
Yeah.
right on that band of like, it's a B-ish neighborhood where you get the right rents to purchase price. And you're paying a fair price, but you're getting a property that there's 50 in Edmonton that makes sense fundamentally.
Oh yeah, good example. I have a client right now that owns a property with 2 full kitchens. It could potentially be 2 separate suites, but it's got 5 bedrooms and 2 kitchens. And his original intent for purchasing that property was like, hey, he's by the university, he's going to buy this property, he's going to rent out all the rooms. Talk about cash flow. It's a cash cow king. And at the end of the day, time is phased. He's like, I'm not interested in that property anymore. It's paid its dues. I live in a different house now. I don't want the maintenance. I don't want that. And so having a property like that at my disposal, it allows me to say, hey, if you're looking for a great cash flow property, that's a really unique situation, but we're not going to market. He's like, I don't want all my neighbors to know I'm selling this thing. I just want to know that this is something, hey, if there's a deal that we can put it together here, that's an option. But all this discussion, Keaton, brings me back to the rates, and it brings me back to the creativity. And I think the 2 things that have come up this summer, and you and I have dealt with it a little bit, but I just want to deal with it again, just on the open here. People have to remember to be creative. And what I mean by that is sometimes going with a 5% down instead of 10 or 15% down, and then utilizing the lump sum payments and saving them from having this crazy long mortgage by just saying, hey, you know what? We could put 10% down. Let's put 5. Even those are CMHC, there's still a situation there. And then we can really chip away at that interest and the life of the mortgage by putting additional payments down. That's a great creative strategy that you and I both talk about on a daily basis. But I think not enough people really go back to that result again, whether you're putting 5 or 10 or 15. The idea of adding the lump sums or doing the, bi-weekly accelerated option where you get to pay a little bit more of the principal down. And overall, it takes 3-4 years off your mortgage just from the accelerated option. But then let's look at a different scenario. 2 families. I sold a property this year, Keaton. It was 2 brothers that wanted to buy a property. I was the listing agent selling this property, but 2 brothers approached and they said, we have 2 families with kids. We're twins. We'd love to live together anyway. Okay. Their families get along well. They wanted to buy this triple suited house that I had listed. And the reason that they wanted to do it is because they said, look, for this price, it was a luxury home. It was, $800,000 plus. But here's a situation where 2 families were purchasing this triple suited home together with some land attached to it right outside the city. And they said, we couldn't find a beautiful house like this individually. So here they are, family members buying this property together. They have their own living space. They have their own land. They have the ability to just live their life like it's in the city in their own house. And here they've put their brains together, put their down payments together, and they've got a beautiful property that they can all hang out on a regular basis. That kind of creativity is actually what's kind of spurred and inspired me to kind of go down this path again and continue to do real estate, now into 20 years more, is because of the fact that there's always a creative way you can make something happen to make your life more comfortable. It's not always about spending more. So I don't know, do you have any stories of, people that have kind of done that joint purchase family just to say, hey, you know what, we're not renting it, but we want to make a purchase together? Because I think people forget that's a good option.
No, we see it quite regularly. And it's, when I was a little kid, we had neighbors and they, as a family, lived in one home and they were relatively new to Canada. And they had kids the same age as my brother and I, so we played with them quite regularly.
Mm-hmm.
And fast forward now, it was a relatively new family, series of there was 3 families living in this home, and they now own 2 vineyards, a trucking company, an organic winery. I think they've got
Wow.
15 houses,
Yeah.
and none of them had post-secondary education to my knowledge or anything like that. It was just a team effort. They all pulled on the rope together.
Yeah.
And we see it with clients. There's an exponential gain to the amount of money you can save and how you can move forward when you pool resources. And we see that with joint ventures. We see it with partnerships.
Yeah.
Some players that are in the space of raising capital through exempt market dealership and other options. So absolutely, we see it on a regular basis in all different facets of the real estate investing space. But I do agree that we don't see it as often in the homeowner space.
Yeah.
It's becoming more popular out of necessity, but
Yeah.
sometimes it's got to suck a little before it gets better.
Yeah, and I mean, it's interesting too, because a lot of the time those are luxury homes and or they're more expensive homes. But when you think about it, hey, if I'm going to buy a $500,000 home and my family member or friend that I really get along with, well, they have a family they want to, and they're going to buy a $500,000 home, it's even more than $1 million, right? Like, because you're looking at, okay, 2 large down payments, 2 different interest rates. I mean, how much now you're spending, $2 million for those 2, because you're both paying $1 million over 25 years. You buy that 1 million to 1.2 million as a joint opportunity with 2 dwellings on it, 2 houses on it, and or 2 suites on it. And then all of a sudden now it's more affordable, but you're both paying less interest and you're both paying less down payment because you're sharing it. So there's lots of interesting things that come out of the market when they change.
That's one thing that throws people's heads for a spin is, let's say you're looking at a townhouse for $200,000. The idea that a $300,000 house could actually be cheaper to own, or the idea that $300,000 home might be more expensive than a $400,000 home with a suite, or that $400,000 home with a suite might be more expensive to own than the $500,000 property with 2 suites, or the $500,000 property with 2 suites might be more expensive to own than the fourplex for $600,000. It's very interesting to see what happens when you actually look at the numbers. But I think one of the things I want to touch on, and this is kind of unrelated, we're jumping all over the place, but one of the mistakes that homeowners should look out for, whether you're a real estate investor or homeowner, is if rates are rising and you're worried about it, one of the temptations is to take your cash and start paying your mortgage. And that's fine if you're in a really stable position and that if you have the financial fortitude to ride out rising interest rates. But if you think there's any vulnerability, if interest rates go to 6.5%, 7%, you're not going to be able to afford your payments. I would argue that it's actually better to keep that extra cash in reserve, because if you end up in a situation where maybe the overall cost of your mortgage is $200 a month more than you can afford, the person who takes $10,000 and just pays down their mortgage is still going to start going $200, maybe it's $195 or $190 a month in the hole every month. Whereas the person who keeps that $10,000 and keeps it as a safety net has 50 months where they could carry that, which hopefully would be long enough to get on the other side. So it is a little bit of a gamble. You are juggling fire in a sense that if you get to the end of the 50 months and things haven't gotten better, your situation hasn't improved. You bought time, but maybe not for any positive purpose. But it is something to consider, because I see a lot of people throwing cash at their mortgages right now, which academically is good. But in application, if you run out of cash or you don't have the carrying power to support those payments if they rise, it might not be the best solution in the real world.
100%. And just to tie that in, one more element more is, we know utility costs have gone up. And if it wasn't for us to have the ability to say, hey, you know what? Oh my gosh, my utility's $200 this month more than it usually is. To have that savings on hand to just protect yourself from these volatile situations that are sometimes short-lived, sometimes they're a little bit longer span, but to carry you through those. Really, really important, for all of us to think, it's a good time to remember to purchase in your means. But using these tools and working with, people like yourself and myself, Keaton, it's nice to be in a position where we're able to help people identify these creative options, because even if none of them come to pass, it's important, before just jumping in and going, I'm going to do this, to figure out, is this the best solution? What's your why?
No, absolutely. It's shocking how many people that I've come across over the years that are very established, well-respected, seasoned, but then you see the mistakes that they've made, that they've learned from, but you see how much it can set people back. And I'm all for shooting for the stars if you know that you're that kind of person where you're going to take that risk and you've got a good chance of succeeding. But personally, the way I live my life, run my business, invest, and the way I suggest for most Canadians is it's more about don't F it up than it is about go for the home run. It's about punting the ball and getting to first base. It's not about going for the home run. Because if you think about it, someone who makes good, responsible decisions, particularly if you're younger, and they buy that home and they do the right things. They pay it down. They build savings. If by the time they hit 40, 45, let's say they've got $500,000 to invest now, they have far more flexibility and options than someone who went big and just is constantly trying to, what do I do with 50 grand, 70 grand? And just from experience, and particularly seeing this market shift, I think that slow is steady, steady is fast type mindset, that just be defensive. Yes, when you see a really good opportunity, pounce on it, but realize that if it's not a really good opportunity, it can wait. When you hit a certain threshold where the kettle's whistling, whoo, you've got the resources, then maybe you go into hunting mode. And yes, if you see it's a good deal, it's not exceptional, but it's a good deal, you jump on it because you've got the resources and it's the right time in your life. But if you're not at that point where, the kettle's getting warm, but it's not whistling yet, and you see just an okay deal, it's a good deal, but it's nothing special. If it's not the right time in your life, just don't do it. And I think that
don't force it.
There's a lot of peace and tranquility with that style. And yes, the 1 in 100 that are outrageously successful will do laps around you. But the 30 out of 100 that make mistakes, screw up, life just doesn't go the way they need it to, are going to fall way behind you. It's kind of like the tortoise and the hare. And I think that particularly in these markets, everybody's you got to start thinking about consistency and longevity. But always a pleasure, Chris. I always enjoy these chats and look forward to seeing you next. Actually, no, next week's a Bank of Canada increase, so that's going to be a whirlwind. I guess I will see you in 2 weeks.
Well, we need to make sure that we get enough people educated about these new rates coming down the pipe before they lock anything else in or forget to lock in.
Bank of Canada meeting next week, everybody, on Wednesday. Somewhere between a 25 and 40% chance of an increase, most likely. That'll be on the variable rate side. New fixed rate pricing moves independently based on the market, but I think we've got a big fork in the road coming up next Wednesday.
Okay.
If they increase,
well, nothing like keeping us informed, as you always do, Keaton, is the key. At least we can make educated decisions, whether it be in fear and in response. At least we are knowing ahead of the game. Never good to find this stuff out after it's already happened.
It's some days feels like playing the band on the Titanic, and other days feels like the person manning the lifeboats. But then the nice thing is you see that third group of scenarios where people are still doing really well and prospering in this market. So there's definitely a few different themes that go on, but
100%. And thank you for being our lifeboat and helping us with our clients getting through this. This is great stuff.
I appreciate it. Look forward to seeing you in a couple of weeks.
Fantastic.
Cheers.